Good afternoon, Marcy Briggs with the Briggs Lang team at Nova Home Loans. Wendy asked me to talk to you guys today about investor loans. And by investor loans, I mean you're planning to buy the house and rent it out. So it's considered an investment property. The most common questions that I get asked are, what am I going to need when I apply for a loan? It's not a one-size-fits-all answer, but typically you can be prepared to show 2 years of personal tax returns, 2 years of business returns if you own a business, if you're self-employed, K-1s, things like that, 2 months of bank statements, 2 pay stubs, any assets that you have, 401ks, things like that, and any properties that you currently own, we're going to want to see things like a mortgage statement or an HOA statement if there's an HOA, so that we can properly calculate all of that into your debt. Now, on an investment property, we're typically going to want to see 20 to 25% down on a conventional loan. A conventional loan is the only way you're going to be able to go on an investment property. You can't do VA, USDA, or FHA. We did an earlier clip that you guys may have seen on HomePath loans. HomePath does also offer investment property financing with a smaller down payment that typically ranges from 10 to 15%. Without mortgage insurance, but it does have to be a HomePath qualified home, and the interest rates are higher. Now back to the 20 to 25%, what we'll typically do is we'll analyze which makes more sense for you, 20 or 25% down. The interest rates are going to be more aggressive with 25% down. We've got this awesome new program for new real estate investors, so call us if you have questions on that. A lot of people are under the impression that if they haven't been landlords before or had a history of managing rental properties that they can't buy, and that's not necessarily the case. So call us for details on that. Again, Marcy Briggs with Nova Home Loans and Wendy McCroskey from Keller Williams asked us to talk to you today. Thank you.
Now, Marcy, I actually have another question for you on
ma'am.
that. Is there any way that an investor that doesn't have 20% can get into, other than the HomePath? For example, I had a customer ask me if he could take out a line of credit to put his 20% down and qualify for the loan.
If the line of credit is not secured to the property, so if he's getting some type of money over here that we aren't lending him, then in theory on our end he'd still be putting the 20% down. It just wouldn't necessarily be coming from his bank account. So that's something we could look at creative financing that way. But to answer your question, in most cases, no, they would need the 20% down.
Got it. Okay.